Now, Enterprise Bank is now one of 3 banking institutions fully owned by the Asset Management Corporation of Nigeria after it injected fresh capital into 3 so-called bridge banks designed to absorb some of the assets and liabilities of the banks that failed to recapitalize ahead of a central bank deadline. Let's now find out a little more about how the Asset Management Corporation of Nigeria is supporting the transformation of these companies. When AMCON took over the ownership of Keystone, Main Street, and Enterprise banks in August 2011, it inherited institutions that were really struggling.
The way they funded their operations was to borrow money from the interbank market at very, very high rates, sometimes 18, 19, 20%. And as anybody knows, no bank can make a profit if it's funding itself at 20%. So these banks were averaging a monthly loss of 2 billion a month. So there was a cost to delaying this intervention. If we waited 6 months more, the combined cost in those 3 banks alone would have been 36 billion naira.
The tough task of running these institutions began with the hiring of fresh management that quickly realized the challenges presented in changing the fortunes of these institutions.
You know, in 2005, there was a consolidation in the Nigerian banking industry, and 6 banks came together. Trans International Bank, Fountain Trust Bank, Omega Bank, African Continental Bank, Citizen Bank, and Guardian Trust Bank. They came together to form what was known as Spring Bank PLC. Different levels of crisis. That was, after the consolidation, when the 6 banks came together, they were confronted with a lot of consolidation challenges.
When the successor bank, came along, Keystone Bank, I would say there was a monthly loss rate of about 2 billion naira. Customers were fast jumping ship, and there was a lot of real serious problems in the financial sector.
I think it would be an understatement to say it was in shambles. Clearly, it was a very bad state, what we met on ground. It was very difficult to extract data from the system, so we had issues with the accounts. So it was very difficult. It took us about 6 months before we could actually produce a general ledger. So we were not too clear as to what we had in our hands, so it was tough. There was also the staff issues. Staffs were highly demotivated. There was a lot of fear and apprehension because of the various interventions in the past. So people were scared they were going to lose their jobs, and really most of them were not too certain at all their fate. Then on the side of the customer, we're also very worried that it could be a run on the bank. And so there was a lot we had to do. So the first thing was really to stabilize the institution and to ensure that we achieve a greater buy-in from the workforce. We needed to also win customers' confidence.
The first step in the turnaround of these banks was to redefine their business objectives.
So what is important for us is to create value. What is important for us is to reposition the bank as a retail bank. So we've invested heavily in technology. We've invested heavily in staff development, and we've also invested heavily in creating alternative channels, because the industry is now shifting from the traditional people coming to the banking hall to other channels of delivery. So our target is to run a highly efficient and technologically driven institution.
The bank has gone through a restructuring process in terms of its corporate organogram, and we now have a regional and functional kind of structure which places responsibilities squarely on people. Very aggressive IT deployment. We have one of the most modern servers, in the market, and of course our watchword is optimal customer service delivery.
The strategic trust is really more to focus on the retail segment of the business. And why is this so? We have 220 branches. The strength of the old bank, of the legacy bank, is really to also leverage on this. And the bank used to be very strong in the collection business, in the retail business, and we say, okay, fine, let us focus on this. And that was the decision of the board. So in the long term, over 10 year, the 10-year plan really is to return the bank to that position, where it was one of the big four.
After a slow start, the banks were beginning to reflect the impact of their restructuring.
None of those banks is losing money. And I think that one or two of them will report at year end, from what we're hearing, management accounts, significant profit.
We've been able to bring the bank to the path of sustainable growth and profitability. As against an average loss of 2 billion monthly, we're in a position where we now return averagely over 1 billion in profit. For the year 2012, we will be posting a profit of about 15 billion. That is just conservatively for the year 2012.
But the success of these institutions is more than just financial. The decision to create the bridge banks safeguarded trillions of naira in deposits, including public sector deposits. In addition, it meant that thousands of jobs in the three banking institutions were preserved. The management of the banks indicate that AMCON's role in achieving this performance cannot be overstated.
And what they have done is to ensure that we have enough liquidity, to operate commercial bank operations in Nigeria. And so far, they've been very supportive as shareholders. And we as commercial bankers also, we believe we have the adequate capital to compete with all the players in the industry.
I think AMCON has made considerable contribution to the institution. I think on the personal level, they've been very supportive of me, and I'm sure the same of the other two CEOs of the other banks. They do not interfere. They've allowed us to actually run the institution. They have actually displayed a very high level of professionalism in the way they relate with us. And I think that has actually helped us. They've also been able to, they've injected capital to allow us to address the negative capital in the business. And then they've also taken NPLs from us. And that has also released more liquidity for us to do the business. And from the depositor side, they've been able to address the issue of loss of funds. So you have a situation where depositors will have lost their funds if AMCON did not intervene in the bank. Staff will have lost their jobs as well. Borrowers will not have been able to, all they will then get is the NDIC premium, which is really not much. So they've been given the opportunity to assess funds, those businesses that are viable. Those that had issues with meeting their obligations have also been able to, restructure their facilities. As a result, they are able to run their business and, deal with whatever capacity they are able to handle, in the areas of repayment of those loans.
The next critical step for AMCON with respect to the banks is to sell their shares to new investors.
AMCON is a public institution. And even though there's some kind of wall between a public institution and government, there's still a close relationship. And it's not government policy to own banks, as we know. So it is imperative that AMCON return those banks to private hands as soon as it's practicable. Practicable means three things to AMCON. One, we must try to get back as much of our money as possible. So that's important. Two, we must do that without disruption to the financial market. And three, we must have a process that we can defend. Banks are sensitive institutions, they are licensed, they are public good. We cannot be seen in any way to be parties to taking banks from one party and handing them to another favored party.
The process to sell is already in progress. By February 15, AMCON's financial advisors will present options to AMCON on what to do with the three banks. The sale of the banks will be a key contribution to the cash flows AMCON is expecting to use to liquidate the bonds that it has issued to finance the resolution of Nigeria's banking crisis. But as with most things related to the resolution of Nigeria's banking crisis, the recapitalization of the bridge bank has not been without controversy. Shareholders of some of the banks whose investments in these banks were wiped out in the process declined to comment for this report. However, some are challenging the central bank's handling of the process in court, accusing the Apex Bank of unfair treatment. Furthermore, several employees at the newly formed banks are also making claims of wrongful dismissal or for the payment of severance benefits. However, analysts say that notwithstanding these legal challenges, the bridge bank option chosen by Nigerian authorities was the best to ensure the safety of bank deposits and the stability of the financial sector.
Confidence in the banking sector is a key part of having a pillar for future development. You and I know that there have been many people that have lost money in banks in the past and still have no resolution several years later. And the view was taken early on in the process that going that route of leaving uncertainty for depositors was the highest cost of all. So anything else was considered to be a preferred option. So in that regard, I think it was a sensible thing to do.
The only reason people put their money in the bank is because we gave them a license. And they believe that since we gave them a license, then their money is safe. So in the event of a crisis happening, our primary constituency is the depositor. And this is what I think has now become understood by people. Now, if we save the depositors, and if in the process we can save the shareholders, we'll do it. If in the process we can save employees or minimize attrition, we'll do it. If in the process we can protect management, we'll do it, if management is not responsible. But if we have to sacrifice other parties in order to save depositors, we'll sacrifice them. And if you look at the recent letter issued by the British and American regulators, I think a few weeks ago, they've basically said that. They've basically said next time there's a crisis, shareholders will take a loss. I mean, that's the whole idea of being a shareholder. You take the upside when the bank does well. You basically get all this money from depositors, trade with it. If you make the profit, you take the upside. But if you lose it, then you take the loss. Yes, shareholders were not happy, but if you've got negative capital, then you've lost your investment. That's all it means.
Enterprise, Main Street, and Keystone banks. They remain symbols of the ingenuity of Nigerian authorities to draw a line below a crisis by preserving deposits, saving jobs, and restoring confidence in Nigeria's financial sector. It is expected that these banks will be sold to fresh investors over the next 15 months. It's anyone's guess who will own the institutions when it's all said and done. But what is clear right now is that the central bank, the NDIC, and AMCON have provided a lifeline to these institutions to fight another day.